Cast is now starting. All attendees are in listen-only mode.
Hey everybody, happy Unenjoyment Friday. Oh, you right, Steve. You're right. Steve, you are on it. All right, give me a second. Let me see if I can pull a rabbit out of my hat. Steve, I love shooting from the hip. Okay. There we go. Fixed. Thank you, Steve, for catching that early so I had time to look at it, but Steve always starts webinars awake, but doesn't always end that way, though. Well, I hope I can keep you awake. You bought the course. Look forward to going through the lessons. I appreciate that, Steve. Thank you, and I appreciate you being on the ball because I dropped the ball there. That's for sure. I had all kinds of good vetted ones for the long puts too. So keep in mind, I haven't vetted any for this one yet, but we can do that on the fly. It's Friday afternoon, clearly an unenjoyment Friday. We used to call it unenjoyment Friday on the floor because of was the non-farm payrolls. Ricardo, you will have a replay, yes. What we'll do after I shoot this webinar, basically I tape it and then I have to convert it, which takes about another hour or so, and then I have to upload it, which takes another while, and then usually kind of gets out Saturday morning or somewhere thereof, because by the time we're done with this, it's usually, well, by the time I'm done, it's usually well past 5 o'clock East Coast time. So some of the support staff is at happy hour or something. So yeah, we will be sending it out. All All right, give me a second to get this set up to record. Oh, wait. Hold on a second. Let me do this because it auto. Okay, this is being recorded, you guys. One thing I say at the beginning of all of these webinars is watch this again shortly thereafter, because it'll make some of these nuances that I'm talking about stick into your head, if you will, and you'll remember it. At the end of the day, I'm going to be talking about nuances in this particular webinar that you guys may not have heard anywhere else. I mean, it's some of the things that we talked about on the floor that I learned there. You know, when is the right time to be doing some of these trades? Some of the times when we were doing these trades, we knew we shouldn't be doing it, but we had to make a market, and you know, that was our job. So we learned very quickly when the right time was and when the wrong time was to be implementing a lot of these different strategies. This particular one is going to be on covered calls. So one of the reasons we're doing this as a beginner course is actually, this is how I learned to start trading options, to be quite honest. I had a couple of stocks in my portfolio that weren't going anywhere, and one of them was Walmart, the other one was IBM, and Walmart would get up to I think it was like $46 back in the day, and then it would tumble all the way back down to like 43, and I was just watching the stock go sideways. And the same thing with IBM. It'd get over $100, and I distinctly remember I was always selling like the 101 calls against my stock. It'd get called away every once in a while, but in the meantime, you know, a lot of times that option was expiring worthless. So I was able to lower my overall basis. And I think that this is a huge opportunity for people to get into options, because a lot of us have stocks in our portfolio, and you know, the stocks will have a tendency to kind of trend sideways. And even if we're in a bull market when these are trending up, we're going to be picking an option that has a very low probability of being executed. Now, we do have to keep in mind that this call or these stocks may be called away from us. So when you're implementing this strategy, you need to have that in your forefront, that they may be called away. But having said that, you can always buy some puts and stuff like that later on, and actually you sell some puts, start selling some puts, getting into options that way, and get those stock back at a price level that you would want them. So that's kind of how you play this covered call strategy. Is if it does get called away from you, you sell some puts and you get that stock back. Otherwise, you continue to make money by selling those puts. So that's what we're going to be looking at playing with. I'm going to only talk about the covered calls, but keep that in mind as well. You know, if you want that stock back, then sell some puts and get that stock back if it gets put back to you, right? But you need to pick a level that you're comfortable with as well. All right, but anyway, so this is, believe it or not, a option strategy for beginners, because this is literally how I learned how to trade options. But let me get a couple of things out of the way real quick. My name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Like I mentioned, I started trading in college. As soon as I graduated from high school, went to college, put some money in a bank account, and started off with a psychology degree. And this guy at the bank called me up one time and said, hey, you know, do you want to invest some of this money in some stocks? And, you know, I took him up on it. So I bought some stocks, and then I kind of got bored with just watching these stocks trade sideways and went to sell them, actually. And the guy was like, well, you know, you can do options and stuff like that if you want to kind of be more active with this portfolio. So that's how I started getting into options. And then I decided, hey, I'm getting rid of this psychology degree and moving it over to finance, and then graduated with a finance degree and literally packed up all my stuff, moved to Chicago, and started working on the floor as a runner. That's those guys that run around and hand paper up into the pits, and decided to sell all my stocks and everything else and bought my badge, jumped in the pits and started trading. So that's how I got to that point, and then, I've switched over to basically trading on the screen. As you can see here, I started out, I was one of the first guys to throw a screen in the pits. But in that time, I've traded everything from stocks, financial futures, commodity futures, and currencies, basically on all these products in all market conditions. Let me go over this disclaimer real quick, and then I'll answer some of those questions. I think I see a couple of people throwing up some questions. Any opinions, news, research, or analysis, or other information contained here or material provided by ProTrader Strategies and associated companies is for general commentary, does not constitute investment advice, you guys. I can't possibly tell you, go out and buy this stock and do it as a covered call strategy because it works out great. Well, at the end of the day, I don't know what your risk parameters are. I don't know what's in your portfolio, and you may be very tech heavy, and I could be suggesting a tech stock. That does not make sense. I mean, you need a balanced portfolio. That's one thing I will preach to the end of the day. And the other thing is I could overweight you in one particular stock, which isn't necessarily a proper investment strategy either. So just take what I teach you guys and implement it in your portfolios in your own way. We're here to teach you guys how to swim, not to swim for you. So take that for what it's worth. Anyway, do your own homework, and please remember that past performance of any trading system or methodology is not necessarily indicative of future results. You guys can follow me on Twitter at Wolfman's blog. This is me personally, and then our parent company at ProTrader Strat. And increasing your gains with covered calls. And this is really, by far, in a way, one of the best ways to get into options. We did the long calls. That's a low probability strategy. This, even going out and buying stocks is really a quote unquote 50-50 shot at making money. If you go out and buy a stock today, you are 50-50. Yeah, over the last couple of years, we've had a great run and most people have made money, but there's still the probability that in the next month or so, that after you bought that stock, that it's going to go down and you're going to lose money on that value. So when you're using a covered call strategy, you can increase your probabilities of success quite dramatically. But let me get these questions out of the way real quick. Is covered calls for buying options or selling options? Good question, Robert. It's actually selling options. But when you're doing a covered call, it is the assumption that you are long the stock and then you're covering that stock with a call. Okay? So that's where it comes in with covered calls. The calls are covering the stock. Now, yes, you are going to limit your upside in that stock, but you're lowering your cost basis of that stock. So if I bought, a stock at $100 and then I sold, a call against it and collected 50 cents for that call, well, then I've lowered what I've overall paid for that stock. So synthetically, you're lowering your basis. Yeah, it's not really because, well, in a sense, it's not really. It's synthetic because you've captured that money. But the idea is you are lowering your overall basis and what you paid for it when you sell it, and you're all flat, then you've made some good money. All right, so I mentioned this. Probability of profit with buying a stock is 50-50. I mean, there's no ifs, ands, or buts. It is 50-50. So why do we do covered calls? We're lowering our basis. I mentioned that. You could, and I've seen it done, cover your cost basis to zero. Yeah, it's very difficult to do that with like $100 stock. But if you're starting out with something like, GM and things of that nature, especially even a utility stock, you can do this covered call strategy and lower that cost basis where it was like you have that stock on for free because you've collected so much credit over time. All right. And a price that could not otherwise be realized. And what that means is if I go out and buy the stock and I sell the call, that's that same idea, is that I've collected a credit for the call and I've been able to buy that stock synthetically lower than where just going out in the open market and doing that. All right. And it's adjustable based on your assumption. Now, what I generally talk about is selling like a 16 delta call against this. But if you think that this market has had the market in this particular underlying has had a big move and you're long that stock, well, you might tighten it up a little bit or think, hey, you know what? Every time this stock goes to 101, it dips back below 100. Well, you might start selling like that 101 call or the 102 call and collecting a bit more credit for it. And you can lower that cost basis even faster. And you increase your profits whereas a stock alone wouldn't give you those profits. And what that is you're always collecting a credit. You're giving yourself another dividend in a sense when you're doing this, because you're able to collect another credit every single month. Now, for some of you guys that may have thousands and thousands of stock, I mean, I know a guy that used to live next door to me in Chicago, and he actually retired at like 38 or something like that. The guy started investing in stocks when he was in his 20s, kind of like I did. So we kind of hit it off. But this guy had thousands and thousands of shares. He did dips, which is dividend reinvestments, and built up this huge stock portfolio. And I started talking to him about selling calls against it, and he started doing that. Now, one thing I would mention, he probably had, I think, about 30,000 Exxon stock, and I was telling him, when you're starting this out, start out very small, even if it's 1 or 2 lots against a 30,000 lot position. Yeah, you're not going to lower your overall cost basis that much, but when you're getting into it, you also don't want to get out of all 30,000 of those the first time you did it. If you sold a call, it's only about a 16% probability those stocks are going to get called away from you. But what happens when the probabilities beat you on the first go around, in a sense? Well, that's not something everybody wants to deal with. So start out very small, a percentage of your overall portfolio to get your feet wet. And then even if you have a huge portfolio, I would never do a covered call strategy to cover all, even if you had 1,000 lot. If you have 100 lot, well, you're going to have to kind of do that. But if you had 1,000 lot, start out with like 3 or 4 or 5 calls, because that would be equivalent to like 500 stock. So you have to be willing to part with 500 of those stock. But then again, like I said, then start selling some puts at a level where you would want to go out there and buy them, because we all do that when we're buying stocks, right? I mean, you don't just sit there and have the light bulb go off all the time, or at least I don't, and go out there and buy a stock, right off the bat. At the end of the day, there's usually kind of a level we're looking for. Hey, if Apple pulls back to this level, that's where I'd like to get into Apple. Well, why wait for that to happen? Why not be, more aggressive and start selling puts? And then when it reaches that level, you get the stock put to you. And if it doesn't reach that level, you're collecting that credit. Okay. So that's kind of the idea. You did not explain what is covered call. Sorry, Dan, I thought I did. A covered call basically is when you buy the stock and then you sell a call against that stock. Okay, so that's the call is the covered call, because the idea is that call that you're selling is covering your position. In a sense, like when you think of trading, let's say, when you cover a position, that means you got out of it. Okay, so a covered call is where you're getting out of that stock. Does that make sense? Does that make sense to everybody else? Because I think somebody else may have asked that question too. So a covered call basically means the call that you're selling is covering your position. But, take this to heart, you guys. I don't always recommend that if you have like 1,000 contracts of XYZ to go out and sell 10 calls, because for every 1 call, it's worth 100 of the underlying. Okay. So if I was long 1,000 stock, I would probably sell 5 calls, which would be equivalent to 500 of the underlying. But that's where I'd be willing to get out of that underlying if the stock went to those calls. And yes, you are limiting some of your upside, but keep in mind that the probabilities of selling a 16 delta call is only 16% chance that the underlying will reach that price and be in the money by a penny at expiration. It's only a 16% probability. And I'll go through that a little bit more when we pull up the platform. I'll show you all those details a little bit more. I think it's a little bit easier to grasp then. Yes, I will give some examples here in a second. But let me get through some of this other stuff just to make sure everybody's clear on the concept. Guidelines. Use shorter duration option contracts. We don't want to do this out, 200 days. We want theta decay. We want this premium to decay as fast as we can. And this is a representation of theta decay. And what happens is further out on the timeline here, our options contracts don't decay as fast. But the closer we get to expiration, we really see this increase quite dramatically. And then even in the last 7 days, it really tanks off. So we're going to try and capture this kind of decay in our premium. And on the floor, we used to call this theta decay, the thief in the night that would come and steal our options premium. Well, we want that thief in the night. So we want that thief we want to unlock our doors and open it up, have an arrow pointing in, come steal it, because we want that premium to come out of our options. All right. Correct strike location. And this is what I was talking about to make it a little bit more sense. Now, if you are more bullish in this particular underlying, then these are what I was talking about. These, if you've heard of standard deviation, a lot of you guys heard the bell curve, from school or something like that, where, your teacher grades on a scale. Well, this is how she figured out who had the A's and the B's, basically, is off of a bell curve. The C's should land somewhere in this part of the bell curve. The B's in this part of the bell curve and the A's up on this part of the bell curve. Same things for D's and F's down this side. All right. What we're looking to do is to capture, what I was mentioning about a 16 delta. That's a 1 standard deviation move. And a 16 delta, if you look at 1 standard deviation move, the probabilities are, you add all these up, 9 plus 9.2 plus 4.4 plus 1.7 plus 0.5 plus 0.1. Basically, that's very close to 16%. All right. So 1 standard deviation move is about a 16% probability of it landing outside of there. All right. Which means you have an 84% chance of it landing in here when you buy the stock. Okay. Because it can go all the way down here or land it anywhere in here. And this is a 16 delta anywhere above or at that 1 standard deviation. So there's only a 16% probability that that stock at expiration will land somewhere up here. Jack, yes, this is being recorded. And we will be sending it out. So like I mentioned in the beginning, watch it again also, even if you're catching most of the meat of this anyway. All right. Be mindful of dividends and earnings. At the end of the day, when you have a dividend, the market could drop by the amount that your dividend is in that particular stock, which is going to be actually pretty good, but you just don't need to be mindful of that. And I don't like when there's an earnings cycle coming up, I don't like having my covered call strategy on during earnings for that event. And the reason why is because anything can happen during that event. And for the amount of money that you're going to be collecting for these premiums, it's it's not worth the limit to your risk to the upside because it could really pop. And so I stay away from the month that has the earnings in them. So if it's coming up, in the next 30 days, then I'm not going to do the covered call strategy during that earnings event for several reasons that I'll talk about. One of them is as you're approaching, if you sold it and in that earnings cycle, the closer you get to that earnings, volatility increases, which hurts call selling strategy, okay? Because as you get volatility to expand, the premiums inflate as well. So that strategy isn't going to allow those calls to decay like we would want them to, right? All right, so make sure that the options have good markets also. That's choosing the right underlying to do this with. If you have stock in your portfolio that has, let's say, AutoZone or something like that, that has really wide bid ask, or Aon, this isn't probably the best strategy to do in that, because you have to give up so much edge to get in, and you're taking a lot more risk because to get out is much more difficult also, because if you have to give up an edge to get in and an edge to get out, well, there's that theta decay component. So if I had to give up 25 cents to get into this particular, if the bid offer is say 50 cents wide in the option montage, so let's just pull up a platform real quick. And GLD is not going to have that problem. So let me just pull up Aon because I used that as an example earlier. And let's say, everybody's heard of Aon, but there's just not a whole lot of participation in Aon. I mean, it is a $130 stock, but 35 cents wide, and I'm talking about the 18 delta or the 16 delta is what I was talking about. So 18 delta is pretty close for government work, right? Well, to get into Aon, because there's not a lot of volume and open interest, you can see 3 contracts traded in there. So in order for me to get filled on this, I probably couldn't just go in and offer 70s or 70 cents to sell this this call. I'd probably have to go all the way down to like 60. Okay, so if I got filled at 60 cents, I gave up 15 cents to this side. Well, 15 cents really equates to a lot of time, because if we look at this, the theta on these, it's only going to decay. This option premium is only going to decay by 2 cents a day. So if we gave up, what did I say, 15 cents? That's going to be like 7 days before, and nothing else happens, this option premium goes to 60 cents offer in a sense. So I am in this for that long, and all I can do is, make maybe a penny or two to get out. So you took a lot of risk, is what I'm saying, and didn't get really paid for it. So if we're taking risk, we need to get compensated for that risk. So make sure, Aon's $138, all right? So let's look at an equivalent, basically, in price. This is a $160 stock. And if we go in here to that same 18 delta strike, look at that, it's a nickel wide. And there's so much volume and open interest going on in something like this. Look at that. There's a lot. That means there's a lot of people playing this. And in that, what I'm saying is I could probably offer $1.07 and get filled because somebody wants to pay for it. I'm giving up 2 pennies here, maybe 3 to get in, say 3 cents. But, that just means that I only have to wait basically 1 day before that premium starts being offered, and nothing else changes. It's exactly the same price tomorrow. Volatility doesn't change. All other things being equal, tomorrow, or Monday, the next Monday, it's going to decay by 3 cents each one of those days. But let's just say tomorrow it would be worth $1.07. So you can see I didn't have to take as much risk, right? Does that make sense to everybody? How about leaps as the underlying? anything special to consider there. HR, yes, there are quite a few things. And I actually do a webinar, and it's called Poor Man's Covered Call. And it is a way to synthetically create an underlying stock position. Of course, you don't get the dividends, but to create a synthetic covered call position. It's called the poor man's covered call. And same, vice versa, poor man's covered put would be, if you wanted to short the underlying, and that's even, if you've ever wanted to short a stock or thought about doing that, using a poor man's covered put is a much, much better way to do that. But yes, you can synthetically create this with the poor man's covered call. Much less margin also, because we're not buying that stock, and you can pay a lot less in margin. But okay, so do you guys get that? Why don't just do this in any underlying, in every underlying that you have in your portfolio. Make sure that the bid offer in the option montage, which this is all an option montage, all these different months and everything else. So this is called the montage. So if I ever refer to that, you know what I'm talking about. Make sure the bid offer is tight. And now what does that mean? What does tight mean? Well, any stock under $100, my rule of thumb here is make sure from the bid to the offer is no more than 10 cents. Okay, no more than 10 cents between this bid and this offer. That Aon, it was 15 cents or so. It was a little bit wide, but I do have a rule. Anything that's a stock under $100, 10 cents wide. Any stock over $100, just move the decimal 3 ticks to the left, and that is where our bid offer should be. So, for instance, Apple should be no more than, let's say, 17 cents wide, which fits that rule. $1,000 stock, you move it 3 ticks to the left, $1 wide. And something like Amazon, which a lot of people like to trade, that's $1,000 stock. So my rule would be move it 3 ticks to the left, and we have $1.16. So our bid offer in this option montage, on the ones that are close to at the money, should be no more than really $1.16. And as you can see, Amazon fits that rule. It's 95 cents, inside of $1 there. So that fits the rule. So that would be one that we could trade covered calls against. And if you look at like the deltas, so we would look at like the 1240 calls, and that's where I would start out like selling this strategy. And if I had 1,000 of Amazon, then I'd probably do, when I'm starting out, 2 or 3. Okay. And you can also pick, like if you're into technical analysis, you could say, when I'm doing Fibonacci retracements, let's see if I can get this to work real quick, because sometimes when I've got the video going, it doesn't really like to pull it up for me, and it's not going to, because my computer's getting bogged down by everything. It doesn't like to do it all the time. So let's see if I can try it one more time. All right. So, if you do the Fibonacci lines and stuff like that, you could do the same situation. Well, it's not going to go through here probably, or, you could do Fibonacci extensions, things of that nature, or your support resistance levels. You can add that in there as well. Like, let's just look at something else like GLD, because I think I have fibs on there. If I was long GLD and wanted to do a covered call strategies, you can do this on ETFs. Yes, you can. It's the same idea, lowering basis on the underlying. Then I might sit there and go, well, where are these Fibonacci levels kind of lining up? We've got it at 120 and at 123. And so those are something I'm going to be looking at for GLD. So where is the 16 delta? Well, it's 123. So that would fit perfectly with that, right? I've got 2 resistance areas that I've got to go through. So that might be, go through all of this stuff, you guys, when you're laying out this strategy. And one thing I highly recommend, I have some of you guys that I see are returning guys. I have like 5, spiral notebooks here that I just keep right next to me, and I write down all my trades, still do after 25 years of trading. Write down every trade I do, why I got into that trade, where I expect to get out of that trade, and when I get out of it, where I got out of it, so I can keep track of all of those things and what kind of went on to make me either make money or lose money, so I can keep track of all that stuff. And that's really important, write down what your theory is. You go through all this brainstorming. Gold, I think gold's going to go up because I think Bitcoin's going to crash. Whatever your thought process is, I don't care how crazy it is. Go through that. We're coming into the Indian wedding season, I think I don't know when that is, but they always talk about how gold always spikes during that time. Maybe that's what that whole thing correlated to. So write all that stuff down, where your exit strategy is, and make sure you stick to that. Always stick to that. All right, so max profit on this is the stock, or is the strike minus the purchase price plus the premium that you pay. This is for the premiums that you have to pay, the commissions. All right. Sorry, that's the premium. I didn't add in commissions on this one. So the strike price minus the purchase price. So if I bought it at 100, if I bought the stock at 100, I'm selling the 110 strike. It's the 110 minus the purchase price plus the premium. So I have $10 between the purchase price of the stock of 100, the strike of 110, and then I collected, let's say, 50 cents. So my overall max profit would be $10.50. Does that make sense? And a covered call strategy usually at onset is what we're talking about there. So, and the same thing goes once you sell that, this strike goes and expires worthless. Let's say the 110 strike expires worthless. Our stock went to 105. We collected 50 cents. Now the next month I go out and I sell the 120 strike and collect another 50 cents. Well, now my stock purchase price is still at $100. I'm at the 120 strike now. Collected 50 cents the first time, 50 cents the next time. Now my difference is $21 is my max profit. And you keep doing that. And what I was talking about with, buying the stock for zero, synthetically, if you can get those premiums constantly to add up to what the purchase price of the stocks was, then you've gotten that stock for free. You have no more risk to the downside. 1 second. Okay, so you can continuously do that. All right, and then max loss. Your max loss is the purchase price of that stock minus the premium. One of the benefits that we were talking about earlier is with the leaps and doing a poor man's covered call is that, you have a synthetic put added in there, so it's not always going to zero. That's not what your max loss would be. But with this one, it's just like with any stock, right? When you go out and buy a stock, it could go to zero. Well, what's the probability of that happening? Probably, generally speaking, depending on how risky of a stock you're purchasing, not very likely. And the ones that we would be trading are not really usually going to be in jeopardy of, or having in our portfolio are not usually in jeopardy of going that low. But keep in mind, your max loss is your stock purchase price minus that premium. And again, if you do this over several years, that premium adds up and it's subtracted against your purchase price of that stock. So you could synthetically have a max loss of zero. All right, so our break even is the stock price, the purchase price of that stock minus the premium you made. So where the break even would be that same price. Okay. All right. Your return on investment. This is a good one because this is the reason why you don't really want to sell it off. Your max profit is divided by your basis, and your basis is what you ended up paying ultimately for that stock minus all those premiums. So keep that in mind. And then your loss on investment is the loss divided by that basis. Just if you wanted to keep these little valuations on the books, like what your return on investment were and things of that nature. You'll see that you can increase your return on investment by doing this strategy is basically what I'm coming down to here. All right, so let's pull up the platform without further ado from boring you guys. Let me see. I think I see a couple of, I wish you put the number rather than just saying it. Thanks. I will. Well, I'm going to try and go over all that stuff. You're talking about the max profit, max losses and stuff? Is that what you're talking about, Robert? All right, so this is what I was talking about. So if I go out and buy, you guys feel free to throw out any stock you want to look at. We'll go through all of my rules to make sure it fits, and then we'll look to implement this. And sometimes I do implement these on Monday after we do these webinars. I will say that I'm not a huge fan of doing covered calls because it takes up too much margin by buying the stock outright. I'd rather do the poor man's covered call, but I may do it with a poor man's covered call then. But throw in some stocks and we'll start taking a look at them. We probably want something that may not necessarily be at all-time highs, but we would want to be bullish on this underlying. We don't want to be wildly bullish, but we want to be bullish. All right. Jack's got the first one out, CCL. All right, Carnival Cruises. Jack's going to go on a cruise and says, you know what? I want to get paid for that cruise. All right, so Carnival Cruises. Let's take a look at the option montage. It is a $66 stock, so we want the bid offer to be about 10 cents wide. They're a little wide. It could be Friday. It's 15 cents wide. Let's just look at the volume and open interest on this and just see. There's not a whole lot of volume on this one. But, you know, it's not the best. But if you are long Carnival Cruises, let's just say, we'd want to go out and buy the stock. So, look, every time you buy the stock, we got 100. So every one lot in the options is equivalent to 100 of the underlying. We'd want to go out to like the 16 delta, okay? Closest to that is probably 14, depending on how bullish you are. You know, you're going to be a pick 'em between these. I would probably lean, especially when I'm first trading this, go a little further out. And then we want to sell this stock against it. You cannot create a custom covered strategy. Why aren't you going to let me click on that? Let me try it this way. So, because I think it's trying to make me sell 100 or 1,000 of them. So let me go down to a one lot and see if I can do this. Why aren't you letting me do this? All right, let's just do it the easy way, old-fashioned way. Go to a covered. I don't want to do a collar. I want to do a covered call. Covered stock. There we go. So covered stock. So let's delete that. Covered stock. So what was my strike price that I wanted on that? Sorry, flying by the. So the 72.5 calls is what I want to do. I don't usually set it up this way. I don't know why it's not doing that. So the 72.5 calls is right here. So that's where I would want to go and buy that. So I want to do a one lot in the 100 by 1. So that's how I would look to set this up. So I'm buying the stock 100 times. and then selling the calls against it, and have to pay a debit of $66.59. But keep in mind, I'd never go to the mid price. Always go a little bit lower than that by a couple of pennies, because the underlying is moving back and forth. So why not put it in there? It doesn't cost you anything to enter this trade and then cancel, replace it. Okay. If you put this in the first time and hit confirm without changing anything and you get filled, it means you left money on the table, you guys. So it doesn't cost you anything to cancel, replace, but if you get filled right away, it did cost you something because you gave up too much edge in a sense. Okay? Does that make sense? All right, so you already, Bill's saying he already owns, oh, sorry, that's something else. You own 2,000 shares of CVX. How should I trade this? Okay, so if you have 2,000 of this and you've never traded, let's look at CVX, and I'm pretty sure they don't have the best, excuse me, options. So with that being said, I would look for this 16 delta here, so 125, and look at your chart if you like looking at charts. That would have to be where you are willing to get out of it. Now, you probably don't want to get out of all 2,000 of it. So this is how I would play it. It's got tight bid ask. It's a $100 stock. It's inside of 10 cents on all of these. I would go in here and sell the stock. So you have 2,000 of it. Maybe if this is your first time doing it, go down and trade a 5 lot. But you have to be willing to get rid of 500 of those CVX at 125, right? So when you're selling this, look, it automatically put me at 43 cents. That's the bid. And that's what I'm talking about. If I put that in and get hit at 43, that means I probably gave up way too much edge. Okay? It doesn't cost you anything to cancel, replace. And with these stocks, excuse me, got a tickle in my throat all of a sudden. With these stocks that are pretty tight, there's people that want to get out of their position. And there's also spreads in here, there's, a strangle or whatever. There's different kinds of spreads in here that are leaning on one another. And once they see an offer, then they auto leg that spread for you, which means the computer trades that for you. So, I would just better the offer by a couple of pennies, put it in, confirm and send. I'd wait long enough for me basically to go back there, cancel, change the price, and then hit send again until, I got to about mid-market, which about 40. I probably wouldn't go much more than 43 cents or whatever, but work it that way. Now, what happens if the first time you do this, stock goes up to, 130 at expiration in 42 days, it's trading 130. Well, yeah, you did give up room to the upside. That is true. But as you can see with any market, even CVX, it goes up and back down. So, I might just be like, if it went up to 130, I might just be like, you know what? If it comes down here back to 120 or something like that, I want to buy it back, or 115, let's say, then that's when I would go in there and just start selling these 110, 115 puts. Just sell them for a credit. And then when the market goes back down there, after a couple of months or whatever, then that's where I buy them back at. I let them get put to me. They put me the stock, and I'm back long those 5 contracts. In the meantime, you've lowered your basis again. Okay, does that make sense? So sorry I couldn't do, I was thinking I was doing the long put spreads for some reason today, and I was reminded I wasn't, so I wasn't able to vet that, why I never been able to not click on that and leg that covered call strategy. I don't know why. Maybe it's because of my leverage that they're giving me, that it's not letting me do that. It's giving me the leverage of not having to pay, for 100 of the underlying, which is what it looks like. So sorry about that. that's how I would play CVX. Sell this, a portion of it, maybe a quarter of your holdings, a quarter or half, depending on what you're comfortable getting out of, and do that. And then if it's only a 16% probability of the stock finishing, what this delta tells you the probability of the underlying settling or being 1 penny above this strike at expiration of these options, which means it's a 17% probability as of today for CVX to be trading 125.01 on January 19th. Does that make sense? There's only a 16% chance. And a lot of studies show that the probabilities are much lower than that, especially when volatility is higher than where when volatility is above like 50%. CVX has got really low implied volatility right now. So that's probably pretty close to being accurate. And doesn't look like there's any earnings or anything like that, so you're good there. And the reason why I said I don't like selling these options going into earnings, you can see as we come closer to earnings, generally speaking, of course, CVX is not a clean example of it, but volatility has a tendency to ramp up heading into earnings. Let's just look at the Apple example again. Why won't you click on that? Let's go. AAPL. So Apple will have a tendency to do that. So, heading into earnings, especially that last month, you can see volatility increases. And if we look at premiums on, say, even just, all right, so Apple, what we can look at is what happens to volatility what happens to our premiums when volatility increases. Right now, you can see we got the bid offer, the mark, which basically is the mid market. Theoretical price is 220 because we haven't changed anything. But what happens when we start increasing volatility? Watch this price over here. Volatility starts increasing. You can see that price starts going up. So we don't like to have volatility increasing on us. All other things remaining the same. The price of the stock hasn't changed. The date hasn't changed. It's still today. Volatility starts increasing. Your premiums go up without the market moving. So we would really like the volatility to come out, because if volatility comes out, you can see what then happens to the premiums. Okay. Now, I don't always look at what volatility is when I'm doing a covered call strategy. I don't really care, because the idea for me here is I'm going to probably be riding this strategy out to the end of the day. Okay. You can look at it where you cover it for 50% of max profit, like I talk about with most of my other covered or my short call strategies. So for instance, if I sold Apple at $1, and when this premium was down to like 50 cents, let's say, that might be where I cover it, just so I don't ever have to worry about that getting called away from me. And that goes back to your example of CVX. You sold it for 45 cents or something like that. When it gets down to like 15, 20 cents, you got a nice credit for it. You could buy it back, take that credit, and move on. Okay, move on to, let's say, the next month or something like that, and continue that. Does that make sense? What is the difference between volume and open interest, and which one should I focus on? Well, they're both very important. So I wouldn't, and they really go hand in hand. So volume this is what's traded today. This is how many contracts traded today. Open interest means how many of these contracts are outstanding? Means if I go out and, with options for every buyer, there's a seller, right? So, for every 96,000 buyers, there's 96,000 sellers with open interest. Because if I go in and get out of one of mine, then that open interest would then drop by one. Okay, so, but this is the volume, open interest here. That just means how many open contracts are out there. And what that means is, there's 96,000 eyeballs in a sense, that not really, because, somebody could have 1,000 contracts on, but there's a lot of eyeballs out there watching this market. So they see somebody better the market, coming in at $2.19 and something like Apple. Somebody might be like, boom, I'm hitting that. I'm getting out. That's somebody just bettered it, so, or if I bid 19 or 219, somebody might come in and offer 220s. Okay. The other thing it means is there's a lot of spreads in there too, because if I have on a call spread, it might be leaning on these, so I might be, $2.20 to sell the $2.25, $2.20. I might be $2.20 bid to sell these 190 calls at 25 cents, right? But because they're on different exchanges, it's not going to auto leg it until it sees an offer at $2.20. And as soon as that offer comes in at $2.20, then boom, boom, it'll auto leg it. Okay. So that's the other thing. When there's a lot of things going on in here, there's actually price in between here that you don't always see. So if you go in there and just hit the 218s, you blew right through the spread machine and wasn't able to give you a better price. So always work your way in tighter. Does that make sense? If stock goes down, what is your loss limit when doing covered calls or poor man's covered call? Well, on the poor man's covered call, the beauty in it is, you can't lose any money once it goes below your strike price that you bought in those long dated ones. With a covered call strategy, I'm usually looking at this as one of my covered calls. The only time I have a stock in my portfolio, generally speaking, is if it's part of my core position. A lot of people like to have their core position where their favorite stocks are in there, and you're kind of riding those out for the long haul. If you wanted to do this on as if it were a stop loss, then I would usually look at like a 15 to 20% correction, but my risk tolerance is much greater. So I don't necessarily with this strategy have an exit strategy for you other than continue, because I'm assuming if you bought this stock, you love this stock, and you're going to hold it in there for, 10 years or so, right? Because you're an investor in a sense of that stock. So your risk parameters might be different than mine. So that's the way I would look at that. And the other thing is if the stock goes down, you're still selling that 16 delta call. I wouldn't necessarily sell that call much lower than where my entry level was. So if I bought, Apple at 169 and I'm selling these 180 calls against it, and Apple went down, I probably wouldn't go much lower than 170 calls. And if I could only sell them for 3 cents, I'm not going to do that. It's not worth it, right? By the time you sell this call, and the commissions are going to eat you up, so it's not worth it. You want to be able to at least collect 25, 30 cents. If you're just only collecting 25 cents, I'd let it decay worthless, because to get back out of it, it's going to cost you too much for that risk you took on. So if you're selling something for 25 cents, the probabilities on a stock like this are pretty low. 25 cents means that it's a 5% probability that the underlying will finish at 190.01 at expiration. There's only a 5% chance. Now, a little floor trader hack for you is the delta tells you a bunch of different things, and I have all kinds of videos on what all delta tells you, and I'm not going to confuse everybody with it, but delta tells you what the probability the underlying will finish in the money by 1 penny at expiration. Okay, so that tells you the probability, 5%. But delta, a floor trader hack, also tells you what the probability of the underlying testing you or kissing you, your probability of being kissed on this. So Apple in the next 42 days coming up and trading 190 is 2 times the delta. So in the next 42 days, there's a 10% probability that Apple will come up and hit 190, but only a 5% chance of it being above there by 1 penny at expiration. But in the next 42 days, there's 2 times the delta that it'll come up there and kiss it. Same thing with this 180 call. There's a 36% chance of it coming up and kissing me. So you have to stay mechanical with this. Just know it. All right, if it goes up there, I'm going for it. I know it could go up here and trade all the way up to 185. Just hold on to it. If they get called away from you, they get called away from you. Then you just go down here and start selling the 160 calls. 160 puts to get those back. Does that make sense? How many days out? Great question, Bill. And I think I may have mentioned that earlier, but I'll go over it again. What we want to do is take advantage of that thief in the night, remember? So basically 35 to 45 days to expiration is what I'm looking at. So somewhere right in here, because I want this theta decay happening. This is how, we talked about theta a little bit. But as you can see, that 18 delta is going to trade or decay at like 3 cents per day. If we look at this here, if we go closer to expiration, you can see that the theta is up to 7 cents, and that's with 7 days to go. So that's that 7 cents a day decay going on. All right. So that is inside of here. So it really starts picking up. That's why we want that theta decay, is because we want that option premium to decay quickly. And you can use weeklies if they have weeklies, because usually weeklies will be there when there's a lot of volume and open interest and all the other ones like Apple and stuff like that. So you can, but I like to get 35 days to expiration. And I wouldn't be afraid of doing it 7 days to expiration either if you wanted to just ping away at that. But keep in mind, there's a lot of other things that can go on. You're going to be a lot closer to the market where the underlying is trading when you're at 7 days. So right in here is like the best case scenario, and you get 50% of decay on those and these 8 days to expiration. Okay, so that's what you're looking for, is that real fast, rapid theta decay. So you don't want to go way out here 80, 90 days. You're taking too much risk and you're just not getting paid for it in this particular strategy. Does that make sense? So about 35 days is about the best. I didn't mean to do that. I want to pull up my platform again because we want to get this accelerated theta decay. And if you go way out in time, you'll see theta usually will be like 2 cents. So it's, not very much. So we want fast theta decay. So about 40, right now, 42 days would be the best. And since there's an Apple, you could probably go with the 35 days to expiration to get that theta decay, because it has pretty tight markets in these weeklies. And it's going to start picking up the closer we get to expiration there. that theta number will increase. That makes sense for everybody? And did I answer all your guys' question on the break even and stuff like that? Sorry, I just had dogs break into my office. Okay, great. Anybody else have any other ones? Real quick. All right, hey, so we are not doing this one. I had to change out the thing. So this is the offer we're doing today, you guys, for you guys. It's Pro Trader Strategies. We're doing the webinar on how to trade options for the beginners. This is an options training course. It's actually got a link in the chat window. We've been talking back and forth on the questions box. If you look in that chat box there, there's a link that you can easily click on it. And if you're watching this on the tape delay, you can just pause this and type this into your URL to get this particular offer. But it's a great one. And very important, you guys, FOMC is going to be increasing interest rates going forward. Protecting your portfolio with options is paramount. If there's any risk that nobody is looking at right now, it is this portfolio of, interest rates right here, this one. Protecting your portfolio against rising interest rates. As interest rates increase, the value of those bonds goes down. Yes, you can hold it for 30 years, you'll get par back. That's not what we're talking about. Most people hold it for 7 years. And if you have ETF bond type assets in any one of your portfolios, whether it's in your IRA or your 401k, you got basically 50% stock, 50% bonds. Well, if it's a bond ETF, those guys are going to be buying high and selling low, and they can't help it. They're going to be chasing yield, and you can't chase yield and make up for that loss in value. And that is really going to hurt people. I don't think people really understand how much that can hurt an overall portfolio. So I talked to you about how to protect your portfolio against rising interest rates, options trading stocks. This is all great stuff, you guys. And I mean, if you've learned anything at all from me today, whether it's even a small nugget from an experienced trader, you'll be able to learn something from these as well. I try and make it so it's kind of like a Disney movie, right? It's great for the kids and it's good for the adults. There's little things that the adults catch on those Disney movies that the kids don't catch. And the same thing goes with these webinars. I try and make them so it's good for everybody, because I know that there's savvy traders out there that have been trading options for years, but there's things I can bring to the table for even you guys that you'll learn from. So at the end of the day, I trade with probabilities. I trade, you heard me talking probabilities probably till I was blue in the face. And the fact of the matter is that is the best way to trade. I don't ever say I know what direction the market's going to go. I have a pretty good idea a lot of times, but I'm not always right either. But what I do is I implement strategies that increases my probabilities of success. I do high probability trades, and that's what I try and teach on all these. So if you've learned anything at all, what do you say? Go ahead and click on that link, because you will learn a lot more. And if you are having a bond portfolio, you need to take advantage of this. For that $36, it'll easily take care of itself. So that's about it. I just want to thank you guys all for participating in this particular webinar. We're going to be continuing this whole build out of from basic to even more advanced. And, I'm going to be redoing the poor man's covered call down the road here again when we get to more advanced strategies. But we're going to be covering all those, the strangles, the straddles, butterflies. There's all kinds of different butterflies we can cover. And we're going to be going through from the basic to get you guys familiar with, delta, vega, theta, all of the Greeks, and then expand on that. And by the time we're done with this, you guys are going to have a very solid understanding of options. All right. That's all I got, you guys. If you can't take that, take it easy. All right, I see a couple of questions popping up here. I'll go over those in just a second. But like I said, yeah, this link is a dead link, but the link is in the chat window, George. So you can just go over to the chat window and click on that. Thanks, Johnny. Thanks, Mark. Appreciate it. And Doug, what was it? Is the options basic course only available online, or is it a downloadable course that I can listen to at my leisure because it's on my computer? It is web-based. I'm pretty sure you're going to have to talk to those guys. Talk to us by calling us at 310-598-6677. Trading at protraderstrategies.com is our email you can reach out to us at. But basically what we do is you can watch it, Doug, at your leisure. And what you do is you go on there and say, for instance, we have all of these webinars lined up and they're going to be listed vertically. And what you can do is you click on it, you watch it, and then you can basically check it off to show that you've watched it. Or you can pause it and then watch it again whenever you have the opportunity, Doug. So if you're watching it on a computer, basically it is, through a web-based portal, and you can have those there for as long as you want because you paid for them. So you watch them over and over again too. That makes sense? So it's pretty easy, but I don't think it's like, it's not really downloadable because, we don't want to lose track of our proprietary videos and stuff. So that's really where that comes down to it, right? But you can easily click on those and keep track of where you are, and you could watch it in the middle of the night. All right, guys, have a great weekend. Take care.